When foreign investors establish a company in Vietnam, one of the first operational tasks is hiring an accounting provider. For many startup founders and SME investors, this feels like a practical solution. The accountant handles tax filings, the reports are submitted, and the business owner assumes compliance is being properly managed. But in Vietnam, there is an important legal reality many foreign investors do not fully understand. Even if your accountant files incorrect tax reports, your company, and in some cases its legal representative, may still be responsible before Vietnamese authorities. This means outsourcing accounting does not automatically outsource legal liability, and this misunderstanding has created serious compliance problems for many foreign-owned companies operating in Vietnam. Incorrect tax reporting in Vietnam does not always result from fraud or intentional misconduct. In many cases, the problem begins with operational weaknesses. Incomplete supporting documents, poor communication between the business owner and accountant, incorrect invoice treatment, misclassification of expenses, or accounting providers who simply process filings mechanically without understanding the business itself. For foreign investors unfamiliar with Vietnam's accounting and tax system, these mistakes can remain invisible for a long time. Everything may appear normal until a tax inspection, audit process, or internal review begins, and by then, the errors may have accumulated over multiple reporting periods. One of the most dangerous situations for foreign investors in Vietnam is false confidence. Many business owners believe, "My accountant submitted the reports, so everything must be compliant." But tax compliance in Vietnam is not measured only by whether filings were submitted. Authorities may later examine whether the invoices were valid, the transactions were properly documented, payroll declarations matched labor records, foreign contractor tax obligations were handled correctly, or whether financial statements accurately reflected the company's actual operations. If inconsistencies are discovered, the company may face tax reassessments, penalties, interest, or regulatory scrutiny, even if the errors originated from the accountant. Vietnamese tax authorities generally focus on the company's compliance status itself, not the internal relationship between the company and its accounting provider. This means that from a regulatory perspective, the company remains responsible for ensuring tax declarations are accurate and properly supported. In practice, this creates a difficult situation for foreign investors. Because even if the accounting mistake was caused by negligence from an outsourced accountant, the company may still bear the financial and legal consequences first. Recovering damages from the accounting provider later can be complicated, time-consuming, and uncertain. This is why selecting the right accounting partner in Vietnam is not simply an operational decision, it is a risk management decision. Imagine a foreign-owned consulting company operating in Vietnam for 2 years. The investor hired a low-cost accounting service because the business was still small and monthly transaction volume seemed manageable. At first, everything appeared fine. Tax reports were submitted regularly, basic accounting records were maintained, no immediate issues were raised. But during a later tax inspection, authorities discovered inconsistencies between invoices, bank transfers, and declared expenses. Several deductions lacked proper supporting documents, certain foreign contractor payments had not been declared correctly, and payroll records did not fully align with labor registrations. The company was then required to pay additional taxes, administrative penalties, and late payment interest. The investor's immediate reaction was simple, "But my accountant handled everything." Unfortunately, from a compliance perspective in Vietnam, that argument often does not eliminate the company's exposure. Many foreign investors entering Vietnam understandably want to reduce startup costs, and accounting is often viewed as an area where businesses can save money. But low-cost accounting services sometimes operate with limited oversight, overloaded staff, or minimal strategic involvement. Their role may focus only on submitting reports, rather than identifying compliance risks proactively. Communication may also become a major issue. Foreign investors may receive little explanation about tax obligations, documentation requirements, or warning signs that require attention. As a result, the company operates without fully understanding whether its accounting structure is actually compliant. In Vietnam, this lack of visibility can become extremely dangerous over time. Foreign investors operating in Vietnam should not assume accounting compliance is entirely handled simply because an accounting provider has been engaged. Business owners should still maintain oversight. They should regularly request explanations regarding tax treatment, reporting obligations, and compliance risks. They should ensure accounting providers can communicate clearly in English and explain issues transparently. And they should work with providers experienced in supporting foreign invested companies in Vietnam, not only local household businesses or small domestic entities. Most importantly, foreign investors should understand that accounting compliance and legal compliance are closely connected. A weak accounting structure today can later affect tax exposure, investment due diligence, profit repatriation, and even operational continuity. At LTS Law, we regularly advise foreign investors who discover compliance problems only after issues have already escalated. In many cases, the root problem is not only accounting errors themselves, it is the absence of proper compliance oversight. This is why we encourage foreign investors to approach accounting as part of a broader legal and operational framework. Although LTS Law does not directly provide accounting services, we help foreign-owned companies identify accounting and audit partners that have been professionally assessed for FDI suitability, English communication capability, transparency, and practical experience supporting foreign investors in Vietnam. Because preventing compliance problems is always easier than correcting them later. Incorrect tax reports in Vietnam can create consequences far beyond accounting adjustments. They can affect investor confidence, regulatory relationships, operational stability, and future business growth. For foreign investors, the key lesson is simple: do not treat accounting as a purely administrative function. Treat it as a core part of protecting your business in Vietnam. At LTS Law, we help foreign investors understand the compliance risks that often emerge after company setup, including accounting oversight, tax exposure, and operational compliance strategy. If you are operating or planning to establish a foreign invested company in Vietnam and want guidance on selecting suitable accounting providers or reducing compliance risk, book a consultation with LTS Law. Because in Vietnam, tax problems often begin long before investors realize they exist.